So thanks everybody for joining. More people, keep jumping the call. We have a good number of attendees. We have the pleasure to host Mr. Asko Wei again today. We had the pleasure of having him on our team meeting last week, and it was just a wealth of information and current data. So that was incredible. So if you don't know who Asko Wei is, he's the senior economist for the California Association of Realtors, CAR. Mr. Wei analyzed housing market conditions, consumer behavior, and public policy issues through the use of the data and the survey research that CAR giving us on a regular basis. Once again, the data that you gave us, Mr. Wei, was incredible. So we really appreciate your time. And Paul, who's the owner of the Ford Living Group in Southern California, wanted to share that wealth of information with our bigger scale of agents members. So thank you for doing this.
Yeah, no, thanks, Manny, for putting this together, and Mr. Wei as well. One of the things that I see happening so often is that there's so much information out there, and a lot of it, as news sources make money on ad revenue, a lot of it is clickbait. And as information, but not just information, but solid information that people can count on, puts our realtors in the driver's seat in terms of being a source and a light at a time when things can look very dark and information overload. So to get our information direct from a source that's as knowledgeable and reliable as you is a driving force for us to want to host this call. So really appreciate it. And thank you for taking the time.
Very welcome. Thank you both for inviting me, and I love to share information with you guys. And thank you for the great introduction. I do have some great information to share, and I'm going to do it in PowerPoint format, if you don't mind. And I understand some of you may have heard, some of you may have joined the presentation last week, and for those who joined last week, I'll tell you that I have some new information to share. So, and for those who may not have seen my presentation last week, this will be a great time, to share some good information. So if we're ready, I can get started.
Thumbs up, all yours.
Sounds great.
Great. So let me just switch my screen to show you my PowerPoint presentation first. And I have not sent the presentation to Manny and Paul yet, but I will after the presentation. So once you receive the presentation, feel free to share it. I also will be posting the presentation on the CAR website. And I will have a link at the very end to show you where you may be able to find the presentation as well. So let's get started. Now, in the next 45 minutes, 15 minutes or so, I have the tendency of actually going over. So, if we are over and if you need to stop me, just let me know. But in the next 45 to 50 minutes, we're going to talk about, what happened. What happened since the coronavirus pandemic started hitting the economy and the housing market. Now, because I'm an economist, I'm going to talk about the economy in the first part of the presentation. I'm going to talk about, how the pandemic has impacted the economy. I will tell you that we're already in a recession, that in the last, you have seen some numbers probably, and it's probably very convincing now that we are already in a recession, and we're going to see some numbers that are going to look really, really bad in the next few weeks or so, and in the second quarter. That, of course, affect the housing market. We're going to look at some numbers in terms of sales, in terms of pending sales, and maybe in terms of price, and see how is that, how the pandemic is affecting the economy and the housing market, and also how it affects home values. Then the second half of the presentation, I'm going to show you going forward how it is going to look like. As far as the economy is concerned, what path it is going to take to recover, and also as far as the market, how long this pandemic, how much damage this pandemic is going to affect the future. sales and also the values of the housing market in the future. I'm going to be real. I'm going to tell you that it's going to take some time, for things to recover. There will be challenges in the short term, and of course, I'll define what short term is in the next few minutes or so. But let's first start with a discussion of the economy. So we've been, many of us have been staying at home, being sheltered in place for 2 months, more than 2 months now, right? It started in San Francisco, it started in the Bay Area, but it extended a few days later to other areas in San Francisco and California. So we have been making some changes, and everyone has been making some changes, and those changes affect the economy. Let's take a look at some of those changes. Now, there are some changes in consumer behavior, obviously. Take a look at what happened in the traveling, the travel industry. The reason why we're doing the discussion here on Zoom rather than actually in person is because we're not traveling, right? Take a look at the graphs that I have shown here. I have on the left-hand side a graph that shows you the total daily flights. How many flights that's usually are in the air. If you take a look at some of the statistics from past years, from 2017, 2018, and 2019, they're right around 200,000 flights per day. This is a global number. At this point in May, we should have maybe about 175,000 on a daily basis. Not a surprise. I mean, I go to the airport all the time when there was no pandemic, for business purposes as well as for leisure. So that number, look at what happened this year with the shutdown, with the lockdown of the economy. It dropped more than half. At the end of April, we have a number somewhere around 75,000 or so, significantly below what it used to be on an average last year and the year before. Now that number probably has since improved a little bit, but probably still a significant number. I have a friend who worked for Delta. She told me that 90% of the flights have been grounded. Rightfully so for many people who are not traveling. For people who live in California or who lived in LA, many of you probably don't like to go to LAX to travel. I don't like to go to LAX to travel, for example. I'd rather go to somewhere like Burbank or some other airport. But I'm sure traffic there, even though it might have died down, it might still be a chaos. But because of the drop in daily flights, we have seen a lot of traveling businesses being lost. Take a look at hotel occupancy. Because people are not traveling, the average hotel occupancy rates usually about 66%, 67% or so. This year, it's predicted to drop to 38%, not even half. So the traveling business has been hammered. But there are other areas. What about dining? We are not going to the dining in the restaurants. This is a chart provided. These are some statistics provided by Open Tables. You take a look at the dining Open Tables statistics. These are people. These are seated restaurants, diner who call in to make reservations and things like that. Open Tables that number actually has dropped down significantly since about mid-March or so. Mid-March or so is when the WHO announced that the coronavirus is a global pandemic. That number dropped significantly. Shelter in place were in order around the 15th or so. That number plummeted to what? 100%, a pretty significant drop. Now, in the last couple of weeks or so, last few days, I should say, that number probably picked up a little bit to maybe 95%, but still a significant number. So it affects the restaurants industries, it affects the dining industry. What else? Now people are not going to crowded places, right? We the weekend is coming on Memorial Day. Usually, this is the summer, or going into summer. This is usually the time when we have a lot of box office hit, a lot of movies, right, coming up. Many of you are probably Disney or Marvel fans. There were a lot of movies that got canceled, right? I mean, I personally, I'm a Marvel fans. I was looking forward to, Black Widow and some of the other movies. Fast and Furious were supposed to be out, but obviously they got postponed and delayed. What happened to the box office? Take a look at the chart on the left-hand side. The North American box office gross by the end of the March dropped about 75%. Pretty significant drop. What happened? People are not going to crowded places. Instead, they stay at home. Take a look at the chart on the right-hand side. That's video on demand, that's streaming, Netflix, Amazon Prime. Those are people, instead of going to a box office, going to the theater, they opted to stream movies online. In fact, if you take a look at the streaming, that number has significantly increased to about by 40% by the end of March. What about shopping? Sometimes we go to see a movie, sometimes we go out to dine, but we also go to shopping, right? We're not doing a lot of shopping right now, not in person at least, I should say. If you look at, a lot of people actually switched from going to malls or going to a shopping center to buy stuff. They instead go to do things online. Take a look at the statistics here. For North America, the retail online transactions for the week from May 11th to May 17th actually increased quite significantly by 92%. People were not shopping in person. A lot of people are not shopping in person. They are shopping online. Take a look at the number. The year-over-year growth rate for US and Canadian actually increased more than 100% for e-commerce. For online retail orders, increased by 146%. Usually, again, during this holiday, Memorial Day holiday, usually there are promotions, right? A lot of people are buying things online now. Now, the other part of it that not increased as much is grocery. People still go to supermarkets, grocery stores, but a lot of people are switching to online grocery, increased by 40%. Now, if you are smart and if you're are an investor, and you observe that there is a trend going on, you would have bought Amazon stocks maybe a month, 6 weeks ago. Amazon at the beginning of the year was somewhere around 1850 as far as the stock price is concerned. Guess what the price is now? About 2,400, 2,450 or something like that. So it increased by 30+%. At the same time, the S&P 500 actually dropped by nearly 10%. So you can see the online traffic, online retail has gone up quite a bit. Now, why am I showing all these changes? The reason why I want to show you this is because I want to show you what happened to retail sales. Because of the loss in revenue in box office, because of what happened in the travel industry, because of what happened in the dining industry, a lot of sales have lost. Look at the retail sales in April. This is a chart that shows you the comparison between retail sales in April comparing to March. What happened to clothing and accessories? It dropped by close to 80%. Electronics and appliances dropped by 60%. A lot of those sales actually dropped quite significantly because people were sheltered in place. Now, there's one category that actually increased, on non-store retail, which is online, increased by 8.4% compared to the previous month in March. But March was already a bad month. If you take a look at what happened when we have all those retail sales dropped, even though we have some online traffic, the overall retail sales dropped 16.4% after a drop of 8.7% in March. So how is that compared to history? If you look at history going back by 30 years, the last recession, we had a drop of 4.5%. The 16.4% significantly trumped what happened in the mid-2008. So that's how significant it is. It's a record blow to the U.S. retail sales, and that may not be the end of it. In May, we may have even more significant, drop in retail sales. And retail sales is important because retail sales is a big part of consumer spending. Many of you probably have heard consumer spending is a big part of the GDP. The gross domestic product, our national economic output. Consumer spending makes up about 65–70% of the economic output. And when we have retail sales dropping significantly, we also are seeing significant drop in economic output. The first quarter, even though we only had the last 2 to 3 weeks of shutdown, it already has impacted the first quarter. First quarter, in fact, dropped by 4.8%. What is 4.8% by comparison to the historical recessions? It actually is the worst that we have had since the third quarter of 2008. But also keep in mind that 4.8%, again, is only accounting for this last 2 to 3 weeks of shutdown. Before that, the economy was operating somewhat normal. It was doing fine. So you can imagine what's going to happen in the second quarter. From April to June, when we have those numbers released, it's going to be pretty significant. And I'll show you those numbers, what we believe that those numbers will be very shortly. It has some significant impact, not just on the economic output, but also on the unemployment. If you look at the unemployment rate, we are probably accustomed to hearing unemployment rate at below 4% at the beginning of the year. That's no longer the situation. In the unemployment rate, because of the shutdown, shot up significantly in April to 14.7%. That's actually the highest that we have had since 1933, almost 90 years. Even last recessions, we had an unemployment rate at around 10%, 11%. For California, it was maybe about 12, 13%. And the sad thing is, this 14.7% is probably not going to be the highest during this recession. Next month, we may actually have a number that is closer to 20% or so because of the shutdown. Now, the number of people that are in the labor force, in terms of share of population who works, also that dropped significantly. Before the shutdown, we have a number that is closer to maybe about 63, 64%. Now it dropped all the way to 51%. That's actually the lowest all the way going back to 1950s. Last recessions, that number was still at around somewhere between 60, maybe 58 or so, but down all the way to 51.3%, significant drop. And it's expected. We kind of already knew that is going to happen even before those numbers got released, because we've seen some numbers from jobless claims. On a weekly basis, the Department of Labor released some numbers of how many people actually file unemployment claims. Every time someone actually loses a job and they need unemployment insurance, they file a claim. And that number has been, we have been seeing those numbers stack up for the last 9 weeks. In fact, if you look at those numbers, the total number has already amassed to about 39 million. The latest number that was released this morning was 2.4. I'll show you some weekly numbers in a minute. But the 39 million in 9 weeks, that's pretty significant. How is that significant? How significant it is? You can take a look at what happened in the recession last time. Recession last time, in 2 years, we accumulated about 37 million jobless claim. In 9 weeks, in this shutdown, in 9 weeks, we accumulated 39 million, already surpassed what's being accumulated in the last recessions in 2 years. And take a look at what the weekly numbers are. Now, before the shutdown, it was below 300,000. Then after the shutdown, it shot up to 3.3 million, sorry, 3.3 million. The last recessions, the high that we had was somewhere around 700,000. So you can see how significant it is. And that the first week of million was not the worst. It actually shot up to, actually doubled and actually shot up to 6.8 million before it started declining. So we can see that there is a light of the tunnel. How long the tunnel is, that's the question. We can see that we are actually seeing some decline every single week since it peaked in the last week of March, but it may not be slowing down fast enough. It's 9 weeks. We have already posted 9 straight weeks in the millions. This morning, before this number got released, this last week's number got released, I thought the number would be somewhere closer to 2.3 million, still a little bit higher than I expected. And I do expect in the next 3-4 weeks, we'll continue to see millions of jobless claim. Hopefully that number goes down a little faster. And with that number, the California is actually a big part of it. I think California number of jobless claim was somewhere around 200 to 300,000 or so. The obviously we have been having job growth for almost 10 years, and then that number got dropped significantly in the first week after the shutdown. It actually dropped quite significantly by about 100,000 in the month of March. And that has some serious damage to the California economy. The shutdown means we're losing a lot of output. On a daily basis before the shutdown, the average daily output is about 8.8 billion. And each day we have a shutdown, we have a daily loss of 2.8 billion. That's close to 32% of the daily output. That's why it's pretty significant, and that's why we're seeing a lot of people lost their jobs because of small businesses got shut down. Now, how's that affecting the housing market? We released our housing market data, monthly housing market data earlier this week. Last week, when I had a presentation with Manny's group, I was not able to share this number, but we have the monthly number in April. And I also will have some weekly number to show. But let's take a look at these monthly number. If you take a look at these numbers, the April's number is pretty bad. If you look at the sales, the existing home sales, this is only single family. On a year-over-year basis, compared to last April, it dropped more than 30%, 30.1 to be exact. Before April's number, we were still seeing, a positive year-to-date number, meaning the first 4 months of the year. The first quarter, it was actually still a positive number, but when you add in the April's number, it all of a sudden dropped down to 5.4. So we're already seeing, the number of sales actually dropped below last year's. Now, as far as price, and I'll go through some of those more specific numbers in a minute, but let's take a snapshot of some of the other indicators. If you look at price actually stayed pretty flat, but you have to know what happened before April. Before April, March, February, and January, we were actually experiencing a year-over-year growth rate of 7 or 8%. So that's pretty significant. Now we dropped down to a level that is pretty flat from last year. And next month in May, we probably will drop a little bit more. And the reason why we were able to keep the price level is because of tight supply. Supply remained very, very tight at 3.4 months. Days on market, a lot of properties only stay on the market for a short period of time because of shortage in inventory. And the sales to list price ratio right now, it's still on par with last year's. So let's take a look at some of the more specifics. If you look at the sales number, I said 30.1%. How significant is 30.1%? That's actually the biggest drop that we have seen since late 2007. So in 2007, what happened? That's the recession, right? That's the great recessions that we had in 2007. So last time it was more significant than this time. But of course, this time it is a very sharp drop because of what happened because of the shutdown. And for individual price segments, if you look at individual price segments, you want to know whether it dropped more in the lower price segment or the higher price segments, right? If you look at this graph on the right-hand side, on the left-hand side here, for the higher price segments, we seem to have a little bit more impact. For the 2 million plus, it dropped by 40%. For the 1 to 2 million, dropped by 34%. Now, every single price segment dropped by about 25 or more. But it looks like the higher price segments seem to have a little bit more impact, at least for April. And how does that affect price growth? It does have some impact on price growth as well. If you look at the price growth, the higher price segments actually seem to have dropped, softened up a little bit in the last month or so. Before then, now I'll show you a chart in a minute to show you some history, but take a look at the lower price segments, the 20th percentile, the 40th percentile, and the 60th percentile. Now, some of you may be curious about what that percentile means. The 20th percentiles basically means the price between maybe somewhere around 0 to 350,000 or so, and the 40 to 60 percentile is somewhere around the 500,000 priced home and the 750, somewhere around that number. So those price segments continue to show mild increase, but the higher price segment softened up a little bit. Probably partly because of home sales in the Bay Area that might have softened up a little bit. By the way, these are state number. So if you look at the price growth over time, at least for the last few months, you'll notice the orange line is the percentile at the 80th to 100. That used to, a couple months ago, used to actually grow at a pretty decent level at 10. In fact, for March, it was growing by about 9%, 10%, right around here. Then all of a sudden it dropped. Now there could be a lot of different reasons. It could be people are holding back on selling right now because they don't believe it's the right time to sell. They're going to wait a little bit before selling. So the sales of those segments probably dropped, and it could lead to some price drop as well. And we'll discuss a little bit more in the outlook section at the very end. But let's hone in and take a look at something a little bit more recent. Now, the closed sales, I show you the closed sales of April, right? Keep in mind, closed sales usually reflect what happened, or usually reflect the demand, buyer's demand in about a month ago, because closed sales, pending sales, open escrow usually takes about 30 to 45 days, and closed sales is a reflection of what happened that open escrow about a month ago or maybe 40 days ago. So that's the buyer's interest in maybe February and March. Some of those sales may actually happen, or some of those escrow may have opened before the shutdown. So this is the closed sales would be an indicator of a backward indicator, sort of. But let's take a look at that first. If you look at the latest closed sales figure, if you look at the state number, take a look at what happened in California. This is the latest week, that the last week that end with May 15th. Compared to what happened at the beginning of March, it did drop. It dropped quite significantly, in fact, by about 35 to 40%. So closed sales, we can expect May actually to continue to drop quite significantly. Let's look at it by county. If you look at it, well, let me go back a little bit and show you Southern California first. Southern California also dropped about the same amount in terms of percentage compared to the state, also about 35, 40%. But if you look at individual county, LA actually dropped quite a bit. Well, it actually dropped close to 45%, for LA from 98. This is average daily closed sales. It dropped from 98 to 55 in a matter of 9 weeks, 10 weeks or so, or more like 3 months or so, or 10 weeks or so. Orange County also dropped, maybe not as much as the LA. And then if you take a look at some of the other areas, Riverside, San Bernardino, those areas seem to be doing a little bit better, maybe because of housing affordability, because they are more affordable, but also could be because they're a little remote from the major metropolitan areas like LA and Irvine. So and San Bernardino definitely looks like it's doing better, maybe dropping only about 25% from the early part of the month in March. So closed sales it looks like closed sales will continue to drop it may continue to drop next week or so, but there's something a little bit more positive that might indicate when the closing sales or closed sales will actually start rising. Now, pending sales again reflect a little bit more on the buyer's interest now as compared to a few weeks ago. If you take a look at pending sales, it's a little bit more encouraging. Look at the state again. If you look at the state number, it looks like the closed sales or the pending sales actually bottomed out at the mid-April or so, a few weeks ago, and it started rising. So if that's the case, the bottom right here is probably a reflection of what the number of closed sales are. So from this point on, we'll start seeing a little bit more upward movement. If you take a look at how the last week compared to the very first week of March, you see that there's not a lot of difference. It actually dropped only slightly by about 3 units. That's encouraging. Now, I'm not saying that the housing market will recover right away, but it's showing a somewhat encouraging trend. But also keep in mind, this is the time comparing May to March. Obviously, is not fair because May usually should be the home buying season, it should have a higher number than March. But nevertheless, it's still an encouraging sign to see that we are seeing a little bit more improvement. But also notice the latest week, we do have some weakening in the last week compared to the previous week. Hopefully, this will not be a trend that will continue. Hopefully, the pending sales will continue to improve. But you can see that the last week is definitely better than the mid of April. In terms of individual county, we're seeing LA County also improving in the recent weeks, although it did drop from last week, but it's only about 10% down from what it was in the first week of March. Orange County also dipped. Now the counties that worth noticing is, take a look at San Bernardino. It actually is better than what it was in the first week of March. And what about San Diego? San Diego actually are doing a little bit about the same as San Bernardino as well, also getting back to the level that we saw in March. So again, that's encouraging. Still, there might be a lot of bumps, a little bit of struggles ahead of us, but it's a good sign. Let's take a look at something other than pending sales transactions. Might be another indicator that shows how the market is doing. If you take a look at mortgage applications, these are new purchase applications. So if you take a look at these numbers, the week-over-week percentage is pretty encouraging. In fact, this is the 6th week that we have been seeing some increase in mortgage applications, increase in purchase mortgage applications, the 6th week. We're still seeing a decrease from last year. The year-over-year percent is actually down by 15.1%, still down. But if you look at the history of this chart, you notice, I don't have it here, but if you go back to, let's say 4 weeks ago, the year-over-year percent change was actually down 50% or close to 50% for California. So that's very, very encouraging because we're seeing some improvement in not just the pending sales transactions, but all mortgage applications as well. And I'm sure it has a lot to do with the fact that mortgage interest rates actually are at a very, very low level right now. The mortgage interest rate, the 30-year fixed rate, I believe when I look at the Mortgage News Daily today, earlier today, it was at close to 3%. I don't think we've ever seen anything as low before. Even a few weeks ago, it was at 3.2 or 3.4 or so. But at some point, maybe in the next few weeks or so, we may actually see a 30-year fixed rate go down below. The average 30-year fixed rate goes down below 3%. And it may stay at 3%, below 3% for a little bit of time, depending on how the situation is, how the economic condition is. But if you take a look at the number of new applications because of the low interest rates, it started showing, it clearly shows a trend that is upward rising. The year-over-year percent change in mortgage application, this is a U.S. number, a national number, is actually very close to what it was last year, only down by about 1.5%. So that's good. Now, what I have shown you, those are the demand side, right? Mortgage applications, sales, those are the demand side. What about the supply side? You need, people to put their homes on the market in order to have a sales transactions, right? So what about new listings? If people are not listing their property on the market, then it might be tight and we might not have any sales. So let's take a look. Again, this is the latest week that closed on May 15th. It is a little bit below last week, but it is much better than the bottom in mid-April. So we're seeing a little bit of an improvement compared to the very first week of March, down by about 15–16%. The other areas are also improving. Still not, obviously, it's not as high as the very first week of March, and it is definitely below last year's level. Don't take me wrong, it is improving, but compared to last year, we're still down. But again, it's showing that people may be a little bit more comfortable with the new normal. They may be figuring out, buyers, sellers, as well as agents may have figured out how to actually do a virtual transactions, show a home on virtual tours. People learn to adapt. As far as individual county, the new listings actually bounce back for LA. Again, it is only down by about 10-15% compared to previous or first week of March. And the other counties are also doing okay. San Diego is probably the county with the smallest dip compared to the first week. It's only down by about 4 units on a daily basis. If you look at the showings, this is a number collected from showingtimes.com. Showingtime.com, it shows the latest week in terms of listings being shown. It actually show an improvement compared to the beginning of the year. It showed an improvement of 29%. Now, still below last year's. At this point, it was 52% compared to the beginning of the year. It's still below last year, but it's still an improvement. Now, we want to hear also directly from buyers and sellers, and as such, we always send out a monthly survey to consumers. We want to ask them, whether there's a good time to buy and it is a good time to sell. And the latest statistics show us that buyers are probably a little bit more encouraged, a little bit more motivated than sellers. Buyers, because of, I can understand why they're a little bit more motivated. If you take a look at the chart here, this is a chart that shows you the percent of buyers, or I should say potential buyers. They may not necessarily be buying a home right now, but we ask consumers whether it is a good time to buy or not. Some of them, in fact, 31% of them believe it is a good time to buy. And I said, they're more encouraged or motivated because take a look at this number. Even though we have a short history of maybe about 18 months or so, this actually is the highest number in the last 18 months, or going back to September 2018. And they're probably thinking that, okay, well, interest rates are at a very low level. And also, many of them might have thought we might have actually home prices going down. If it follows a similar trend as what happened in last recessions or so, we might have a significant dip in price. But I'll tell you later on that is not going to be the case. We will have some drop in price, but not as much as what we saw in the last recessions and previous recessions. For the sellers, they're less optimistic. Part of the reason is because they can't put the property on the market. You can take a look at the chart here. You can see when we ask people about whether it is a good time to sell in a home in California, it used to be in March or in February, it used to be close to 60%. That number dropped to 26 and 29%. It's a little improvement in the latest month, but it's still a very low number. That's much lower than what we saw in the previous, in last year or so. And of course, they're not as encouraged because they can't put their property on the market. They're concerned about whether buyers have the financial capabilities to buy a property. They're concerned about how long it's going to take for the market to actually back to normal. So a lot of concerns for sellers. Now buyers, they continue to think when we ask our members, what buyers are thinking, and a lot of the members tell us, based on a survey again, that home buyers actually expect prices to be lower. 82%, in fact, believe that home prices are lower now than before and will probably be lower in the future. And many of them, and about 30%, 1/3 of them actually wanted to renegotiate the purchase price before closing. Some of you may have experienced that yourself, knowing that some of the buyers, they want to test the market a little bit. They wanted the sellers to lower the price a little bit. Now sellers may not be on the same page right now. Now I would think, I want to say, some sellers may actually reduce price in next month or so, or maybe when this drag on a little bit longer. But as of now, sellers not all sellers are on the same page. Only about 29-30% of the sellers actually reduce their price to attract buyers. If you look at the chart on the right-hand side, this shows you the number of active listings with a price reduction. At the beginning of March, we had about 30% with price reduction. That number stays pretty much the same. At the end of, or the or first week of May, that number stays about the same. So the number of reductions didn't really change that much. Whether that is going to continue, it's hard to say. A lot of sellers, instead of lowering the price, remove their properties from the market. About 47% in our latest survey suggests that they remove the property from the market because of the pandemic. So now with all that said, I gave you a lot of information about what's going on with the current market conditions, but you want to know what's going to happen. What's going to happen in the next few weeks and moving on to next year. So let's take a look. Now, it really depends. The economic projections, economic models, what we have been doing may not necessarily matters. It all matters. It all depends on how the projections and the pandemic is going to last. This is a projections provided by the Institute of Health Metrics and Evaluation about the end of March. They predicted that there are going to be a lot of infections, and this number back then said it could rise to it would go above 10,000 people were being infected in California before dying down eventually. But because of us staying at home, sheltering in place, the curve actually has been flattened. This is a number that I got from May 12th. That number has significantly reduced. So the number of cases and the number of deaths actually it's much lower than what we expected before, and that might be the reason why we have in California a phase 2 reopening. But you can see from this chart again that number will probably still continue to have new cases. It's going to take some time. And this is assuming that we're not going to have a second wave. So if we do have that kind of a projection, what's going to happen to the economy? Now, again, it's really hard to predict, and we can only base it on some of the cases that we have seen in the past in other countries. There are 3 cases here. One is the SARS outbreak. The other one is this Fukushima disaster, and then there's one on the MERS outbreak. All these outbreak cases have made some damages to the retail sales, to the economy. So this is what I'm showing you: the retail sales, what's going to happen with the SARS outbreak, how it actually panned out in the last few outbreaks. For the SARS outbreak in China in 2003, it took about 2 to 3 months for the outbreak to spread and took the retail sales down quite significantly before bouncing back. So the entire process from the beginning to the recovery took about 5 to 6 months. Fukushima disaster took about around the same time, 4 or 5 months. The MERS outbreak also took about 5 months or so. Now the current, if you look at this, how long the recovery process is going to be, you might think that 5 or 6 months is going to be about the same. But remember, these are individual countries. What we're dealing with is a global pandemic, and the economic impact seems to be a little bit more significant. In fact, this is something, the economic recessions that we're seeing right now is probably going to be more significant than any recessions that we have seen other than the Great Depressions in 1940s, 1930s. So the recovery phase is going to take a little longer. It's not going to be 5 or 6 months or so. If you take a look at some of the predictions, it really depends on, I'll show you some numbers in a minute, it really depends on the recovery shape that we will be seeing. Now, at the very, very beginning, in the first few weeks or so, first couple of weeks or so, when we started analyzing the pandemic, a lot of economists thought, okay, well, we're going to see a V-shaped recovery. You might have heard that in the news. That is, we're going to have a significant drop in terms of economic output, or we're going to go into significant recessions, and then we're going to have a really fast bounce back because of the stimulus, because of once you lift the shelter-in-place order, everything will be back to normal. So a lot of people thought originally that this is going to be the case, but I think a lot of people changed their mind already. It's more like the U shape or the swoosh shape, which is the Nike sign. And so that is going to take a little longer. In fact, we believe that it's going to take going all the way to maybe 2021 or maybe even 2022. Now, let me kind of briefly go over some of the other shape as well. The Z-shaped recovery is when, so the significant drop is going to bring it down to here. We have a stimulus, and then that is going to overshoot, the projection, the trajectory, and then before coming down. I don't think this is going to be the case. We're not going to have enough stimulus to actually put us, shoot it past the trajectory. Now, this is interesting. The W-shaped recovery may be something that could happen. This is when we have a significant drop in economic output. We bounce back a little bit. And then if we actually have a second wave, it's going to drop again, and then it's going to come back. The L-shaped recovery, I'm not going to even talk about it because I don't think that's going to happen. I hope that it's not going to happen because otherwise it's going to take some time. So let's take a look at what other economists said. Many economists have different predictions. The first quarter number actually is baked in already because we already have the GDP numbers, so don't need to look at the first quarter number. If you look at the second quarter number, it looks like economic output is going to be down quite significantly by 30% or 40%. By most economists' standard, that's going to be significant. Third quarter is the quarter when we bounce back a little bit, but still some believe that we're going to see some drop off in terms of economic output. But fourth quarter, everyone pretty much believes that we will start recovering quite significantly. But even with that recovery, we are going to see the year actually down by somewhere between 5 to 10% as far as the economy is concerned. 2021 will be a better year, but it's going to take some time. What about the market? Now, again, there's no model that we can really look at, but we can take a look at what happened to China. China also had the outbreak. They started the outbreak at the end of the year. Their sales, based on the indicator of the 30 major Chinese cities, their sales actually dropped quite significantly. By the end of April, dropped significantly to close to no sales at all, and then started bouncing back. In 3 months, they went back to the normal level of 100. That is compared to last year. Again, I do not believe that this is going to be the case. Our recovery is going to stretch a little longer. We will start seeing some recovery. If you look at what NAR and Fannie Mae and Mortgage Bankers Association predict, this might be closer to what we can expect for the U.S. We're going to see a sharp drop here. This is the sales of existing single-family home. This is first quarter. Based on NAR, we are going to see a significant drop. On a quarter-to-quarter basis, it's actually going to be about 41, 42% drop. And then, depending on whether you believe it's believe NAR number or Fannie Mae's number or Mortgage Bankers Association, the Mortgage Bankers Association number, the green line, I think it's very, very optimistic. But if you look at NAR's number, it's going to drop significantly before bouncing back in the third quarter. And then the fourth quarter is going to continue to grow, and then the first and second quarter of 2021 will continue to grow as far as sales. As far as price, all of them actually believe that prices will show a positive in the second quarter before dropping in the third and the fourth quarter. And you take a look at the numbers that's being dropped. They're not significant. They're not as high as what we have seen in the past. And I'll explain a little bit why I think people are more optimistic this time compared to last time. Let's take a look at the annual number. I have a lot of quarterly numbers here. You might not need to look at everything. Take a look at the annual number here. Sales in the blue table suggest that this year we're going to see a drop of negative 13.5% to 15%, depending on what you believe in. MBA, I think it's too optimistic. But 2021 will be a bounce back. And as far as price, 2020 and 2021, they both, all of them believe that it's going to be a positive year. What about California? The short term, I can tell you that we are going to see some significant drop. If you just look at the pending sales on a monthly basis, we already saw a drop of 43%. So the fact that it is a 43% drop suggests to me that May we're probably going to see a 40+% drop in closed sales. June may be somewhere close to 30% or so. So the next couple months, it's going to be pretty tough. We did a scenario analysis. Now, this is not a final forecast or anything. We did some scenarios with California home sales. This is the trajectory. This is what we expect will happen in the next few months or so. We may actually make some changes in the next few weeks or so. This is May. This is April. April dropped about 30%, as I showed earlier. It's going to bottom out in May by about 45% or so before it started improving. Now, even if it improves, the year-over-year percent is still going to drop. You know, by the end of the year, we may only drop by about 10%. Now, it is not just about the shutdown anymore towards the end of the year. The shutdown was the reason that we have a significant drop in the May and in April. But going forward, it's about the economy. When people start losing jobs, I showed you earlier, 37 million of people actually lost their jobs. So a lot of people actually will not be able to go back into the housing market for a while. The economy will continue to have an unemployment rate at 10%, maybe by the end of the year or so. So it's going to take some time. What about prices? Home prices, surprisingly, or for a lot of people, I should say, will remain. Even though it will drop, it's not as bad as what a lot of people think. You take a look at our forecast, or the scenario analysis here. Yes, it's going to drop starting next month. It's going to drop 5, 6, 7%. It's going to drop at the end of the year, maybe by about 11% or so. If you take a look at the whole year as a whole, though, it may actually drop only by about 6 or 7% before going back to a growing mode. Now here's a summary of what I think, what we think is going to happen to the housing market before I actually elaborate a little bit. Because the economy is going to drop about 30 to 40% in the second quarter and continue on in the third quarter and fourth quarter, we expect a lot of unemployment. And a lot of unemployment could actually shot up to 20%, and it's not going to go down to 7 or 8% for quite some time. In fact, by the end of the year, we might actually still see a 10% unemployment rate. That's going to lead to drop in sales and home sales by double digit. And that's going to lead to a significant drop, especially in the next couple months or so, 30 to 40% in April and May. And then at the same time, because of the loss in demand, we are going to see in the next few months some drop in sales, some drop in price. At the end of the year, it will probably drop a little bit more before bouncing back. Now, the reason why the year probably will end with a single-digit drop is because we do have a very good 3 or 4 months at the beginning of the year, as I mentioned, at 8 or 6 or 7% of increase in price. So when you actually average out the entire year, the year will drop only by about 6 or 7 or 8%, most likely about 6% or so. But the other part that is actually very important to differentiate this year, this recession to previous recession is we also have a very, very low interest rates. Right now, interest rate is at around 3%. It could actually go a little bit lower, and for the rest of the year, it actually may stay below, right around 3.5% for quite some time. If you compare that to last recessions, I'm sure many of you were in the industry at that time. The 30-year fixed rate at that time, I believe 2008, 2009 was about 5.5%, close to 6%. So the interest rate, the fixed rate was actually a little bit higher compared to this time around. So it gives people a little bit more ability to buy. But the other part of it is also home prices are not going to drop as much as before, partly because if you look at last recessions, prior to the recessions in 2007, 2008, 2009, there were a lot of over-leveraging. If you take a look at home buyers, I don't have the results here. We do our annual housing market survey on an annual basis. In 2005, 2006, 2007, a lot of people actually put 0% down payment. The number that I had in mind was about 20% or 30% actually put a 0% down payment. This time around, when we look at what happened in 2019, 2018, only about, for people who put down 0% down payment, was only about 3 or 4%. So that's a significant difference. But also, people are, because people are not putting 0% down payment, they're actually having a little bit more equity, home equity, as compared to last year, last recession. The reason why we had a lot of a significant drop in home prices last time was because a lot of homeowners, they were not able to keep up with their mortgage payment and just throw their keys back to lenders, which led to a lot of REOs, a lot of short sales last time. I'm going to tell you that yes, we're going to see some REO, we're going to see some short sales this time. Definitely not as much as what we saw last time. And part of the reason is because of home equity, as I mentioned, but the other part of the reason is because of the forbearance that the government is extending to some of the homeowners. The mortgage forbearance that's being extended probably will help. Now, a lot of people have been applying to the mortgage forbearance. We saw some numbers from Mortgage Bankers Association, but how many of those are actually in trouble? That's questionable. I think some of them will be in trouble, which that's why we will probably see some foreclosures. We'll probably see more REOs and short sales, but definitely not as much as last time. Now, the other big wild card that we're unsure of, there are a lot of uncertainties, but the wild card that we're unsure of is whether there is a second wave. I hope there is not going to be a second wave, but if there is a second wave, and if we take a look at what happened to Spanish flu going back to 1918, we do have a second wave. If we're not very careful, then the number of infections and the number of deaths is going to skyrocket, in the fall. If that's going to happen, then of course, all bets are off. Then, the economy will struggle for a little bit longer. Housing market probably will be, a lot of people are going to be stay at home and shelter in place again. I do not think that is going to happen. There is a chance that we're going to see second wave, so we have to be very, very careful. We have to continue to do our social distancing. So hopefully we can avoid that. With that said, I'm going to sum it up with a few bullet points. We're going to see the economy recover. How long it's going to take, it's a little hard to say. It really depends on how long the pandemic is going to be, whether we're going to have a second wave. The market, no doubt, will see some challenges. We are going to face challenges in the short term for sure. In the second quarter, probably in the third quarter as well, sales are going to go down. Price-wise, we probably won't see as big of a drop as what we saw last time. As I mentioned, probably a single-digit drop in price for this year. Next year is questionable. We may see a little bit more drop in price next year, but here's what I would say. It's a little different compared to last time. There were a lot of flipping, a lot of investors buying properties in 2003, 4, and 5. A lot of those were homes being flipped. If you're planning on flipping a property, I wouldn't suggest it. I think home prices will go back to normal in 2 to 3 years, maybe even by the end of 2021. So if you are primary home buyers, I wouldn't. Some people asked me this before. If someone want to buy, is it a good time to buy? I would say, if you're financially capable of doing so, if you don't think you're going to lose your job, why not take advantage of the low interest rates and the decent price right now? I know it's not as low as 20 years ago as far as price is concerned, but this is the interest rate level that we're seeing now. You probably won't see it for a long time after we pass the recession. So if someone is financially capable of doing so, if they're not flipping the properties, then it might be a good time to buy. And of course, given that we have enough supply. The other part that is unsure is, after the recessions, is there going to be any permanent behavioral change? Now, we're already seeing some changes. Before the pandemic, there are probably people who work from home in the Bay Area, probably people working from home, but the shelter in place and the stay-at-home order definitely have expedited the process of people working from home. And companies may not necessarily have to have their workers working in, let's say, 15 miles, 20 miles away from home. And people may not necessarily care anymore because if they can work from home, they can buy anywhere else. So that opens up a lot of options for home buyers. So that also could lead to people buying homes, not necessarily in an area that is closer to work. They could buy actually somewhere a little bit further away with cheaper home prices. So that could also mean people buying in other states. Now, the other part of it is the supply side. With a lot of those businesses, like as I mentioned, retail stores, malls, they may not be, and a lot of them may not be in business. So some of those could be converted into residential property. It's a long process, but it could be converted into residential property. If that's the case, it's going to help the housing market in the long run, but it's going to take some time. So these are some of the changes that could happen, but we don't know whether that will for sure going to happen. And with that said, I would tell you that the housing market probably will do a little bit better compared to the other part of the economy. The reason is this time around, it's not because of the housing market that actually took the economy down. Last time it was for sure. But this time we have some advantage because we have very low interest rates that we have never seen before, but also those opportunities of converting some of those housing supply, converting some of those commercial into housing supply. So with that said, hopefully I provide some good insights, and if we have time, I'm open to Q&A.
And Oscar, thanks so much. I was watching our chat box a little bit, and some of the information given the sort of lead up of what percentage down housing sales are makes a lot of sense given what's been going on as we're getting back to a little not even close to normal, but what people are doing right now in terms of buying and selling. I want to differentiate the sales volume from your predictions on sales price. And so what you were saying is basically at the end of the year, because we had a little bit of a bump up in the beginning before this, but as it sort of averages out, probably, single digit for sure, 6, 7, 8% lower in price of homes. Is that correct?
That's correct. Now, so you're right. When I average everything out, because of the increase in the beginning, yes, it's going to stretch. It's going to average out to 8% or 6 or 7% or so. Now, if you just concentrate on the end of the year, yeah, it could be closer to more like double digit, like 10%. But yes, at the end of the year, we may actually see a higher number than the year as a whole. But going to 2021, I see some positive, because if interest rate continue to stay low, I think it will continue to recover. As the economy continue to recover, I think home prices will continue to recover. It's safe to say, even by the mid of next year, mid of 2021, you may still see a year-over-year percent change of, say, below 5% or so. But it's looking much better compared to what we saw 10, 12 years ago during the Great Recession.
And also to add to some of your stats, one of the things we talked about a little before, and I like the fact that you mentioned that last time we had the recession, really a Great Recession, it was caused by real estate, and it's very different this time. In fact, as last time was caused by real estate, 9 out of the last 10 recessions, if not caused by, were a dramatic lowering of housing values led into the recession, and that's not what we saw this time. And I just want to make that observation, but then I also want to reflect, throw another statistic out to you, and reflect back to one of the things you said was just how much more, less people doing 0% down, and how much safer the housing industry is right now. And I pulled an article that came off of Housing Wire, but quoting a Harvard study that said that the aggregate home equity for Americans in 2011 was $7 trillion. And then in 2018, just 7 years later, and obviously fairly recently, was 15.5 trillion. So I don't have newer numbers in 2018, but in those 7 years, the equity that Americans had in their home was more than double. And then there's the sort of other benchmark of when Americans have more than 50% equity in the housing, and that number is way up. Can you reflect for us how that affects us, and how the realtors on this call can use that statistic to further educate buyers and sellers?
Sure, absolutely. You're absolutely right. There are, compared to 10 years, 12 years ago, I keep on going back and say 10, 12 years ago, because, that's the magnitude of this level, like Great Recessions. We don't usually see it, like, we might only see it once in our lifetime, but we're seeing it twice this time. But this time is absolutely different, because you're absolutely right. As far as the equity is concerned, it's a little different. As I mentioned, a lot of people who purchased a home in 2003, 4, 5, they didn't put a lot of equity down. And so that's why when we had, in the Great Recessions in 2008, a lot of people, actually maybe about half the people, or like 20, 30% of the homeowners, actually had to throw the key back to their lenders, because even if they continue to pay their mortgage payment, it's not worthwhile, because home prices have dropped by 50%. 50% is significant, but this time it is a couple reasons. Now, because of home equity, because a lot of people in 2017, 16, 18, they're putting down at least 10%, 15% down payment, or they have accumulated at least 10, 15, 20% down payment. So even if their home actually dropped by about, let's say 5, even 10%, because they have 20% down, equity in their home, they're not going to throw the key back to lenders. And let's be honest, 2007, 2008, 2009, when lenders got all those properties back, they didn't know what to do with it. Many lenders, they actually do not want to be a property management company. They prefer to work things out with the home buyers or homeowners. So that's why, for these reasons, home prices are not going to drop as much. Homeowners are going to have a little bit more equity. The other part of the reason is, last time around, we had maybe about 30 to 40% of home sales, 30% of home sales were investors' properties. So people did not invest a lot of money in it. They didn't plan on keeping the property for a long time. This time around, we only had maybe about 15% total of the home sales being investors. And a lot of those were not flipping. They were people who purchased a property and want to rent it out, keep it for a long term. And that's why, the mentality is a little different. People tend to stay at a home a little longer, and they keep their property a little longer. That's why we're not going to see a lot of properties being pushed out in the market, which will tank the market. You saw the number that I showed earlier. As far as the months of supply is concerned, it was still at around 3.5 months of supply. Last time, in 2008, 2009, specifically 2009, when the market tanked, at one point we have 18 months of supply. That's a significant difference. Now, there's no doubt we're going to see some price drop. There's no doubt about that. And it also depends on what area. I think because of the tight supply that we're seeing, the lower price segments depending on what market, but you can generally say between 0 to 600 or 700, those areas, it's very tight. Price is not going to drop as much. Now, initially it may, but then it's going to stabilize. Initially it may, because the unemployment is going to be a higher number. So you may actually see some drop off in price initially, but towards probably second half of, or the later part of this year, you may actually see a little bit more drop in price in the higher price segment. But even though there is going to be a drop in the higher price segment, I think it will stabilize also because of low interest rates. The other part of it that actually might affect the higher price segments in terms of price, or in terms of sales and the price, is because of the jumbo loans. You probably have, many of you have seen the jumbo loans, the issues with jumbo loans. In the Bay Area, for example, people cannot cannot put down a 10% down payment anymore. They're required to put a 20% down payment for some of the properties in order to get a jumbo loan. Now, hopefully that is going to be a short-term issue. In the long term, hopefully that will be resolved, and then sales will go back up and price will actually be stabilized again. But in comparison to last recessions, going back to your first part of your question, if you take a look at how home prices actually fluctuate, in terms and during recessions, yes, there are some areas, there are some recessions that we actually have a little bit more drop in prices. But I looked at all the recessions going back to 1970s, the 5 or 6 recessions that we have seen. The first year of the recessions, except for the last recession, the Great Recessions, we dropped by about 20-30%. The first year of the recessions of last few recessions, it's actually dipped only a little bit in the first year, not a whole lot. This time around, it is very different also because we have to, like I said, we have the lowest interest rates, so that might actually put support to home prices as well as now sales. I can't say sales will not drop. This year it's going to drop by more than 10% for sure. But price, I think we will have a little bit more support.
Mm-hmm. So one of the things that you mentioned, and people are putting some great questions, and one of them is about commercial and retail, which I'd love to hear about.
Uh-huh.
But I want to stay residential for one more second. One of the things that you mentioned was, for example, S&P's down 10%, but Amazon stock is up 30%.
Mm-hmm.
I am absolutely not a stock market guy, so discount everyone on this call, discount my opinion. But as I understand it, as Amazon price is up 30% right now, and we see so much more ordering going online, that's already built into the price. Okay, that's built into the increase right now. And when I look at, and I use this as a talking point, but I don't often have, chief economists to talk to about it, and that is if I looked at 10 different possible investments, and 9 of them were stocks. Pick the stock: Apple stock, Amazon, whatever, Google, and one of them is the property that I'm still in escrow on in West Hollywood. I can look at the property in West Hollywood. I can look at the 9 stocks and say, even to a stock expert, I have no idea where these are going to be 5 years from now. And if they tell me they know where they're going to be 5 years from now, I just think in my mind BS. Okay. And when I look at my duplex or 5-plex in West Hollywood that I'm in escrow on right now, I don't know where it's going to be 6 months from now or a year from now. But when you ask me where's it going to be 5 years from now, I believe in my heart the answer is just fine. I can't tell you exactly where, but that 5-plex in a great location is going to be just fine. And I cannot say that about these 9 other stocks. And I mean, call me crazy. Yes, I'm biased on real estate, but I believe in such uncertain times, especially where real estate has not led us into a problematic area, that we can almost look at real estate as a safe haven. Is that crazy? Does that make sense?
I think it makes perfect sense. Yes, there are going to be stocks now. I alluded to the fact that there are some stocks that actually go up and down, and we're not stocks expert or financial advisor, but you take a look at stocks. There are a lot of risks with stocks. There are a lot of risks. Amazon is just one example of going up 30%, but if you look at the other stocks, all the stocks actually dropped quite significantly, and that's the reason why S&P actually dropped 10%.
Yes.
That's the main reason why we're seeing a lot of drops in some of the shares and all that stuff. And as far as the investment, let's say now homes, a lot of properties, a lot of homes, they're used as obviously as a primary residence rather than investment. But even if homes are being used as an investment, over the long run, we have seen, home prices actually, increase quite a bit, except for the time when we had a great recessions that dipped quite a bit. But you're absolutely right. If you just look at, housing properties, there are reasons why we believe, investing in a property is the right thing to do, because population will continue to increase. People will always need a housing unit. So population, continue to increase maybe 1 or 2 or 3% every year. So you can bet on people buying home. Now, if some areas might be a little bit fluctuated a little bit more, let's say in the Bay Area, it goes up by 20%, 15% every year, that might be a little concerning. But you can bet on the fact that, by buying a home, it will increase by 3, 4, 5%, a constant increase in home prices. Because of what? Because we have increase in population, because of the fact that it's a home. It's not a share. It's a home you can actually use to live. So you're absolutely right. It's a little risky to think of selling a home in 1 year, but 3 years, 5 years, hey, I think that's a very safe bet.
Absolutely. And that goes back to your point of, hey, if you're really looking to flip right now, I'd be a little nervous. And we're not talking about advice that I'm giving to clients. I'm talking about my own dollars and cents. And I can easily get out of escrow on this property. And I went back to the owner and said, hey, how about a little price reduction? And they said no. And I'm staying in escrow on it because I just think, 5 years from now, I'll be kicking myself if I got out of escrow just because I couldn't get him to come down 5% or 10% or 1%. So that's the advice that I'm giving to people, and also, and many can lead this too. But I'm looking at some of the questions in the Q&A box, and they wanted to know if they see some rental prices coming down. Are you taking that into account? And then also, what's your view on commercial space, which I would guess would be quite different?
It's quite different. So let's look at, multifamily first. Now, I'm not an expert in all the commercial property, but let's take a look at multifamily. We have already seen some numbers, from multifamily. A lot rental prices, I would say, in the next few months or so, maybe even, towards the end of the year, we probably will see a little bit of a softness in rental. Well, for different reasons. For many renters, they may have trouble paying their rents because of the unemployment situations and things like that. Yes, it's going to be soft. I do not think it's going to have significant. It's going to drop significantly. But if you're a landlord and you plan on holding your property or your rental property for a year or 2 years, that's going to come back. As I mentioned, it is not great recessions back in 2008. The economy will recover a little faster. It may not necessarily be in 6 months, but it certainly will be back a little bit better in second half of 2021. So multifamily will continue to be better, to continue to improve. You might have to hold your average rent or your rent rate at the current point right now, maybe even dropped a little bit, 2-3% for now. It's going to come back in 2021, maybe the second half. Now the other commercial properties might be a little different. I mentioned about retail space, and then also office space. Retail space, if we are seeing a lot of stores actually not being able to survive, people are switching to, and if many of them are switching to online, so some of those retail space actually have already started, tightening up a little bit. Some of those malls probably will be converted. So retail space are probably going to go through some tough time in the next year, and if people's behaviors really going to change in the next 2-3 years or so, we probably will have less demand for retail space, and that again will open up some housing supply. Now, office space is a little different. Office space, there are two arguments, two school of thoughts that's kind of making it unsure about the demand for office space. Obviously, I said a lot of people are working remotely, right? And we get accustomed to working remotely, and it's not going to be just the next few weeks. It probably will be at least the next few months, maybe through the end of the year. So if people are accustomed to working from home, then there might be a less space needed for office space. But at the same time, we also are aware of social distancing. So office space, each cubicle or office may have to be a little bit further away from where they are now. So there might be a little bit more need of office space for that reason. But I think at the end of the day, after let's say this year or so, I think as far as office space are concerned, even when the economy started going back up, I think the need for office space probably will be less than this year, maybe even less the year after. Because the other part of it of working from home is it expedites the process of digital migration. A lot of maybe your office and some of the offices decide to move everything on a cloud or online. And then if that's the case, a lot of people actually will be able to access it from home. So that actually might change the behavior a little bit. So office space, I think in the long run, will probably be less in need. Now, the other part of it is industrial space. If what I believe is going to be the trend, we're going to have more and more online retail. That means there will be a more need for industrial space, storage space, warehouses for people buying online. So that a commercial property, set of commercial property probably will be okay, and maybe even better than before.
Yeah, and just to mention one thing, by the way, we had 8-digit deal that fell of escrow, commercial deal for a big out-of-state call center that wanted to come in, in the Agora area over here and purchase this, whatever property. And they said like, hey, the last month and a half, I have all of my callers working from home or like throughout the state. Like, I'm good. Interesting.
Mm-hmm.
Yeah.
Well, Oscar, I really, really appreciate it, and it's brought so much valuable information. A lot of the things underpinning what you see, and at the end of the day, I'm glad to know real estate did not lead us into this. It could well lead us out. I think that one of the observations for sure is the type of property is going to vary. So a very high-end home that doesn't have a ton of demand, it could be a little softer for sure. When you're in a area that's in demand, lower interest rates coupled by a softness, coupled by demand period is going to drive a house to close of escrow, especially if it's priced well. And again, on the investment side, you're reading tea leaves. I think if you're trying to figure out what's going to happen with retail, it makes me nervous for sure. But again, if you're doing a multifamily and you're looking at some really strong fundamentals, like strong fundamentals are, lower cost housing in nicer areas, an entry level, wherever your entry level is, to a particular neighborhood is going to be pretty safe. And again, if you're buying and you're going to stay in a home for more than a year, you're not a home flipper. I think you can safely say to your buyers, now's quite a good time. Can we pick the absolute bottom of the market? If you're going to try and wait to pick the bottom of the market, you could just as easily miss the bottom as anything else. So if you find a house that you really like and that makes sense for you and you can afford, now's a great time to buy. On the seller's side, same thing. A well-priced home is going to sell. and if you're, same advice really, if you're going to hold for, if you're like, well, geez, I could hold for 5 years, then maybe you shouldn't sell. But if you need to sell with sometime now within the next year, probably right now is a great time to do it.
And I agree with you. I think, the other point that I want to point out is you mentioned about sellers. A lot of sellers, they're also buyers. So sellers, yes, maybe they want to hold off until they get a better price. But at the same time, if they are buyers, they want to take advantage of the fact that, they may be losing the advantage of low interest rates. So if you find the right, I always, give the same advice too. If you find the right place, if you find the right property, if you like it, and this is the time when we have the lowest interest rate right now. Why not? And of course, again, assuming that you're financially capable and you're not putting yourself in problem. If you know that you're losing your job, definitely don't buy. But otherwise, if you find a property, if you're financially capable of buying, definitely do it right now.
Great. That's great. That's great advice. Great information. The more our realtors are armed with real information and not all this craziness that is clickbait in the news, the better. So having a direct source for such phenomenal information is wonderful. And I can't thank you and many enough for making this happen. This wasn't going to happen on my calendar. I'm embarrassed to say if many didn't make it happen. So I really, really appreciate it.
Thank you. We are here to share the resources that we have. So thanks, Paul, for giving us that platform. To a lot of people out there that watching right now is going to watch the recordings afterwards. And Senior Economist for California Association of Realtors, Mr. Oscar Way. Thanks again. Can't thank you enough.
Thank you for having me.
Yeah.
Thank
pleasure.
you.
Thank you, everybody. Thanks for watching.
Bye-bye.
We're going to email you the copy of the presentation once we're going to get it.
All right.
Okay, stay safe. Thank you so much.
You too. Bye-bye.
Thank you.